Hello and welcome to the Hawaii Housing Report. I'm Patrick ONeill with Luxury Homes International in Honolulu, and I'm joined by Hawaii's favorite economist, Mr. Paul Brewbaker. Paul, Happy New Year, and it's great to see you again.
Happy New Year.
This is going to be a
Disappearing
special.
hand. No fingers.
This is going to be our a look forward into 2025 with your predictions on the housing market, interest rates, Hawaii's economy, and we're also going to look back at 2024 as part of a recap. But before we do all of that,
Hey,
let's
why remind us of it?
let's look back at your predictions for 2024. So this was 1 year ago to the
Ooh.
day, actually. And I'm
Tell
going to
me you
go
don't
through
have a
this.
table.
Okay, so here is your question. The first question was, would there be a recession in 2024? And your
Oh,
prediction, quoting Rosanna Dana as part of your research, that no, there would be no recession, despite all the calls for it back then, including Jamie Dimon. Some people will remember. The dollar to yen exchange rate, your prediction was 150. We're right there. We're right around 150 something and change,
five, I think.
155.
Yeah.
So nice, well done on that one. So two of them, two for two so far. Home
Better to be
prices.
lucky than smart.
I think you're smart too. Single family home prices. You said moderate growth, probably somewhere between 3.5% and 5%. We ended the year with annual appreciation of 4.8, dead on. You're three for three, doing really good here so far.
Close enough
Con
for hand grenades.
Condo prices. The question was higher, lower, or about the same. You said probably about the same, maybe a little tiny bit of growth. We ended the year just over 1% price growth for condominiums. So you nailed that one too. Four for four.
It actually looks better than that on trend, but yeah, it's slower there. Yeah.
Yes. Yeah. And we're going to talk all about that and what's happening and why it potentially is going to change. Okay,
Yeah.
interest rates. We were at 6.5% in January of
Ah,
2024. Your prediction is we would dip below 6% and be somewhere in the fives. We're currently around 7% ish, and we're going to bring in Anders in just a moment to try to figure this out. But let me just start with that with interest rates.
yeah.
One, why has it been so hard to predict the interest rates this whole year? And why are they still sticking at these high rates?
The you know, most people would say it's the price of eggs. And okay, I get your frustration with like avian flu, which is what's happening to the price of eggs, and with the persistence of inflation at higher rates than we grew to, be comfortable with during the 20 teens. Um, but they're still like, I don't know, do I have these in here? Let's go look at the charts here. These are housing data that we were going to come back to, but no, I bet I don't have it. But the inflation rate in Honolulu or in Hawaii is higher than the national inflation rate, which measured by the consumer price index is maybe 2.5 to, 2.8 or 2.9%. That it should be closer to 2.4, maybe 2.5. And so the stickiness, it's not going to two, by the way. The Fed's goal for inflation is two, but it's measured a different way. So measured by the consumer price index, it should be about 2.4, 2.5%. And we're close to that nationwide. In Hawaii, we're not, but the only reason is Maui's wildfire. So Maui's wildfire extinguished 2,000 houses, no pun intended. And then Maui forgot to build 2,000 houses for a year and a half. And so everybody's been trying to find a place, scrambling to find a place to live on Maui, and it's bid up, housing costs, housing rents. And those are the things that are moving the consumer price index in Hawaii. So yeah, the inflation part of it is manini kind, but it's not zero. And the risk that inflation might not go down as far as it should or whatever has persisted in financial markets. So when you look at these interest rates, both the overnight interest rate, the projection from the Fed for which is in the dashed line there going out 3, 4 years, and the black heavy series, right? This heavy zigzaggy line. And there's your problem. This zigzaggy line is the yield on the 10-year Treasury note, which has bounced around anywhere from 3.5 to let's call it 4.75%. And we're in the 4.6s right now. And it's like, well, make up your mind. Is it 3.5% or 3.75 like it was 6 months ago or 4 months ago? Or is it 4.75 or 4.65 as is today? And the long end of the Treasury yield curve, the long-term risk-free interest rate, is a basis for mortgage rate finance with and with a premium, a risk premium essentially, that itself is higher than normal, higher than it's been on average for many, 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 many decades.
And Paul,
So
just to talk about this for a
175
moment, just
basis
talk
points.
about
Yeah,
this
yeah,
for a moment. Yeah,
yeah, yeah.
this you pointed this out early on. There's a
We've we've been
risk
talking about it for a
premium.
year.
Yeah,
Yeah,
there's a risk premium that is put on top of the 10-year, and that's basically how we can get to the function
yeah,
of the mortgage interest rate, the 30-year fixed.
yeah.
This risk
So
premium has been historically higher, and the risk premium is pointing out what
yeah.
risk do investors
Okay.
see?
So it's technical. There's like four different things, and some of them are like have to do with the way options are priced and something. But the simple idea is this: everybody just got a 3% mortgage. And right, they went out and refied during the pandemic. They grabbed onto a low rate mortgage in the 20 teens when interest rates were low. So everybody's had about a decade, and then this wonderful moment in the post-pandemic monetary policy accommodation where the Fed took the overnight rate to the zero lower bound, and these long-term interest rates were down here. The 10-year was at like 1%, or 1.5%. So add a 2 percentage point uh, risk premium to 1%, and you get a 3% mortgage. Well, we don't live in that world now, and because everybody does, has a three, not everybody, I don't, but a lot of people went and got this 3% mortgage and revealed their ability to refi at a low rate should a low rate show up. And therefore, if you're originating a mortgage today, which is going to cost, let's take a 10-year yield of 4.75 and add the 2.25, about which you're asking me, why is it 2.25? But just add them together, you get 7%. You get a 7%
Right.
mortgage. Why the 2.25? Because if you're originating a mortgage today, you bear the risk that at some point in the future, when interest rates actually do go down, these guys are all going to come in and refi on you again. And
Got
so
it.
you need to sort of get compensated for that, the risk as a lender that you
Yes.
hold, that they're not going to stay in the mortgage for 7 or 10
Okay.
or not to mention 30 years.
Okay. Thank you. A good explanation. Hey, with that, let's bring in a lender. Let's bring in Anders Hostelli. He's the state manager for Guaranteed Rate Mortgage. Anders, great to see you again. Thanks for
Doing?
taking the time to be here.
Yeah, of course.
Okay, so according to Paul's calculations, with a risk premium of 2.25, we should be at a 30-year mortgage rate of around 7%. What are you seeing right now in the market?
If and I do the scenario where someone's putting a large down payment, really good credit, and usually they'll pay maybe 1 point. So that rate is about 6.75 on a 30 year. But if they're paying 0 points, it's about 7%.
Ah,
So yeah,
so
we're right
so
there.
that's yeah, so that's the figure,
Yeah.
the one that Paul is referring to. I
Hmm.
guess you'd call that maybe the APR with
Yeah, that's
points
the
and
APR.
everything in there
Yeah.
will be at 7. I'm just pulling up now. This is the Freddie Mac data that was released this week.
Mhm.
So yeah, also tracking just above 4%. And Anders, actually, before we go further, let's look at your predictions from this
Oh
past
no.
year. This was one year ago today. Let's see what
Yeah.
Anders had to say. Okay,
Oh,
so the first question I had for you one year ago today was, will we see rates less than 6% in 2024? And you said absolutely yes.
yep.
Anders never got that. That's all right.
Yeah, no, no, no. Maybe that's too
However,
hopeful. Yeah.
I did ask you, will rates fall below 5%? And you said no. So that
Yeah.
you kind of get a half a point there.
Okay. All right. Yeah.
The other one, it's hard to remember this time, but back in January, we hadn't seen any Fed cuts. So I had asked you, do you think the Fed rate cuts will begin in 2024? And you said absolutely yes. So you got that one right as well. Um, but yeah, interest rates have been tough. And Paul
Yeah.
just gave his explanation of why it's been so difficult to predict these and look forward. What would you say? What is your simple explanation of why it's been so difficult
With interest rates,
predicting the
um,
interest rates?
predicting them. Well, I mean, you have different factors, involved in the political landscape, administration, right? I mean, the outlook with Trump, like how is he? Yeah, obviously more inflationary, and that's push mortgage rates and yields higher. We can go into a lot of explanation on that,
Okay.
but that has to do, with what we've seen recently.
Yeah.
And then, the other thing, I mean, the economy is doing really well. I mean, and the inflation numbers, and Paul can speak to this way more than better than me, obviously, are a little bit more stubborn than had been expected.
Right.
So,
Well, that
we see
makes
that
sense.
10 year, yeah, we see that 10 year kind of where it's at.
Yeah.
Um,
And what about rates? So let's just for a simplistic conversation, we'll say the 30-year APR, whatever you want to call it, right around 7%. What about VA FHA mortgages? What do you see there
Yeah,
on
so
the
the
rates?
government loans, like we talked about before, are typically about 3/4% below the conforming. So it's in the low sixes
Ah,
right
I
now.
see.
Yeah. And with VA, for instance, like talking about what Ball said, VA has a requirement that you cannot basically refinance that loan within 210 days. So if
Oh,
somebody at a higher rate, and then, I mean, years and years ago, somebody could all of a sudden do this simple refinance on a VA loan, and the investor, whoever bought the loan, would just have a big loss on it. So now there's some protection there in the last few years. So I do believe there's something to do with that, which makes there's not as high of a risk premium
mm,
on those mortgages, compared to a
okay.
conventional
Oh,
loan, right? Which
thank you for that.
you can refinance, and if the rates just drop, you can refinance in 60 days, 60, 70 days,
Yeah.
whatever it is for you. Mhm.
Well, very interesting. Paul and I are going to talk in a moment about the buildup of condo inventory.
Mhm.
And, we've talked about this quite a bit, the insurance premiums, the vintage, condo problem, deferred maintenance, et cetera. There's been another issue that's popped up, and you helped us yesterday on this subject matter, which is the Honolulu fire safety ordinance that was passed after the tragic Marco Polo fire. Can you talk just a little bit about that as far as the dates, where they are for compliance, and then what that means for you as a lender right now when this issue is raised?
Yeah, so we there's I think there's about almost 300 condos on that list. Condos that were built for a certain period, a year when it wasn't required to have sprinklers. So they have to basically comply with this ordinance. But I believe the sunset date, or the date that they need to comply by, is like 2030 or 2031. So it's several years away. But of course, I mean, there's these evaluations that the fire department will do of a building. They'll come in and say, okay, well, you have a couple options. You either put sprinklers, or you need to do this list of items. Associations, they'll have this report, and then they'll have to decide, because obviously, whichever way they go, it's quite costly.
Yes,
I mean, putting sprinklers is very expensive, but I mean, I don't know. I mean, you could put sprinklers in, and it can actually help with the cost of the insurance
true.
from a
Yeah,
master insurance standpoint.
yes, yeah.
But
And
if you're not
and we,
a lender that's familiar with this requirement, you may
yes,
say, "Wait, what is this? It looks like the building may be out of compliance
I
with."
see. So right now, for you, let's just use your company as an example. If you're doing a local loan here,
Mhm.
is it an issue when you're getting the loan through processing, or has that not been an issue yet?
The only issue is that it got questioned, and then we had to go back and forth, and with an association, or couple, with just asking them about it. But and then they
Okay,
provided the information, but
I see.
we're able to work through that. Yeah.
Okay. Yeah, it seems
Mhm.
a lot of buildings have done the initial study,
Mhm.
which has provided recommendations, but they just simply haven't done the
Right.
work.
Well,
But
the issue will be in when it has to be done or by, and if they don't comply, that will become an issue. Yeah.
right, and it seems the vast majority have not complied yet. there are rumblings of extending that date out again. So we'll see what happens. Okay, let's get your predictions for 1 year from now.
See,
Interest
the thing
rates,
about it is I'm always hoping, right? I mean, there's a little bit of hope in there too,
be
but
aspirational.
maybe I should take some of that out. But I still think by the end of the year, I mean, we'll
Let's say 1 year from now, when we
one
do
year.
this in January of next year, where do you think rates will be?
I think it'll be at 5.7%.
Okay, 5.7. All right. Where do
Yeah.
you think rates will be 6 months from now?
I think they're going to be like 6.5. I think they'll be a little bit lower than now, but not much. Yeah.
Okay. And then finally, who do you think will win the Super Bowl this year?
And you know what? I don't even know who's playing.
Okay,
It's pretty bad, right?
okay. We'll just say Kansas City was your
There
selection.
you
So we
go.
have
Okay.
something in there.
Yeah, yeah,
Okay.
yeah,
All right.
yeah.
Well, you're working too hard. Hey, Anders, thank you very much, not just for today, but for always being a resource when we have
Of
these
course.
issues that pop up. Really, really appreciate it. And I know you're moving offices, so good luck with that. And we'll see you next month. And stand by. We'll be right back with economist Paul Brewbaker.
Thank you.
Market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
All right, and welcome back to the Hawaii Housing Report with economist Paul Brewbaker. Paul, is there anything else you want to add to the interest rate conversation? Anything about inflation?
Yeah, just so that people can visualize what's happening with inflation, I think it's important to remember that um, the Fed has largely been successful getting us back towards, if not all the way back to the benchmark, which in the consumer price index would be 2.5%. Um, they're concerned that we seem to be bouncing above it, so they're moving slowly in following through on lowering interest rates, but they'll follow through because I think that this low inflation is secure. There's uncertainty, and as you and Anders were talking about, the what happens with tariffs, what happens with the federal tax cut extensions, et cetera, yeah, remains unresolved and will be resolved in the next few months, and so we'll know some of those answers. Hawaii had its own bad experience with resurgent inflation. You could see we were back there in 2023 to where the Fed really wanted us to be. But the wildfires, tightened up the Maui housing market, and that showed up in a local and idiosyncratic and one-time inflation surge. It should be getting back to
Yes.
normal this year in Hawaii as well.
Ah, that's good to hear. Good news. Okay, let's shift gears. We're going to go over to the housing statistics, and
Yeah.
these are provided by the Honolulu Board of Realtors. We thank them for all the research that they provide. And we're going to start with active listings, so inventory of units for sale. We can see here homes and condos. Now, compared to last year, single-family homes, there's an increase of 12.5%. Condos is up 56%.
Wow.
Compared to last year. And if we go back to the same time in 2022, single family homes up 13%, condos up 65%. This is really amazing. I can't remember a time when we saw inventory pile up this quickly while the single family is not experiencing the same thing.
And I muted myself, which is probably a Freudian slip. Yes, I mean, these two used to move together hand in hand for 10, 15, 20 years of data we have from the board. And by the way, mahalo to the Honolulu Board of Realtors for always publishing these data so we can gauge what's happening in the market. So the split that you're showing here is a really distinctive and important one to understand because what it says, what it signals to us is that there's something happening in the condo market that's not happening in the single family home market. And we see that in other measures we can talk about in a second.
Yeah. Yeah. And then looking at 2019, so pre-pandemic, and just to put everybody's mind back at that moment in time, the market had come off of the largest expansion in history, both the economy and price appreciation. But we're just at the tail end of it. Things were
Hmm.
starting to appear like it might start cooling down. When we look at the inventory, let's start with condo. it's only down 8%, meaning in 2019, we're almost right back to those same numbers. Single family homes, just the complete opposite.
Yeah, so can we switch so I can show you something just to
Absolutely.
give this some again visual context. I take the Board of Realtors data and I seasonally adjust the data. And so what you're talking about at the end of 2019 is this moment right before COVID. Right before COVID, the after seasonal adjustment, the these two, which all which tended to move together, and for years and years and years, single family and condominium inventory was remaining months remaining moved together hand in hand, and then after the city council began to contemplate Bill 19, which is a way to regulate and suppress short-term rental activity, a bunch of investors began to back away from that market segment. And so you could see those inventories persist, even though, or the time on the market persists, even though on the single family side, the trend was back downward. Why was it back downward? Because the Fed began to lower interest rates over here and in 2018, 2019, after having tried to normalize them for a couple of years, previously 2016 or 17, I think. And that renewed interest rate decline brought a new wave of buyers out. It's just that they were already flocking to the single family segment while the condos were impaired to some extent or stigmatized, as I said earlier, by the Bill 19. Well, the same thing happened last year with Senate Bill 2919. A year ago, the legislature began contemplating legislation that would underscore the right that the counties essentially already had to ban short-term rentals, but this, gave them further political ammo to execute. And that, the two had been separating a little bit, partly because the tourism recovery wasn't as strong, and you can see that right here, right? When tourism drops during COVID, a bunch of people try to get out of their condo investments. That's what's going on here. When tourism recovers, those short-term rentals look a little more attractive, and investors jump in with the low interest rates to see if they can grab one. But then as the tourism recovery peters out, and here comes the wildfire, and then of course SB 2919 clearly creates a market situation on Oahu, not the neighbor islands, a situation where the norm is 3 months, and what's normal right now is the single family segment. 5 months of inventory remaining is abnormal, and it's
Yes.
abnormal for all the
Yep.
reasons we've talked about: insurance
Yep.
problems, maintenance and vintage issues, and of course this threat from the jurisdictions that short-term rentals might
Yeah.
be limited.
Sure. Sure. Okay. Let's shift gears, Paul. Let's look at closed sales, and we're going to kind of wrap up this whole inventory, closed sales, and then prices, and then
Okay?
what I'm really looking forward to your
Yeah.
predictions for 2025. But let's jump over now and take a look at the closed sale data. Hi, this is Patrick. If you're enjoying this information, please consider giving us a thumbs up below and be sure to subscribe so you don't miss next month's housing report. And you can see the figures there, 2793 for single family homes, 4,459 for condos. Compared to last year, we can see that the home closed sales are actually up 9.1%. Condos pretty flat, down 2.5% from a volume perspective. Go back to 2022, we can see we're down 20% and 30%. What I thought was interesting is going back again pre-pandemic
Mhm.
2019 that you from
Well,
these
I mean, we're
figures.
you know we're down 20 to 25% from pre-pandemic sort of normal circumstances. So that's a problem. I mean, that's a legacy of the high interest mortgage interest rates primarily. And well, we're hopeful. Anders and I are hopeful, and were a year ago. So we're still hopeful that rates will settle in over the next several years, which should bring the sales volumes back up. I mean, let's face it, we're talking about 7,000 transactions a year on Oahu. That's not 12,000, right? So
Yeah.
if we go to, if we go to 8 or 9,000 or 10,000 over the next several years, 10,000 would be about a 50% increase.
Right,
That seems like a long stretch, and this is a market that easily used to do 12,000 a year.
right. Yep,
So
we'll
it's going
keep
to
our
be
fingers.
a slow grind back.
Yeah. Okay, and let's jump right into months of remaining inventory. And this months
We did
remaining
this.
inventory takes into account inventory and the absorption rate, or how many units are
Oh,
selling
gotcha. Okay.
each month, right?
I'm sorry. I jumped ahead and
Yeah.
showed you the,
So,
yeah.
yeah, months remaining inventory. So if we look at 2021, we were at less than 1 month for single family homes and 1.6 for condos. Just to remind everybody, we think of equilibrium in the market between a buyer's market and a seller's market, right around 4.5, something like that in those figures. Anything below would be considered a seller's market. Anything above would be a buyer's market.
Okay.
2022, although it went up, it's still clearly in the seller's market range at 2.1 for homes, 2.2 for condos. 2023, slowly increasing, but still in the seller's market range for homes at 2.8 and
Hmm.
3.2 for condos. And then here comes the big jump. Now,
Yeah.
single
Yeah.
family homes, basically the same as 2023 at 2.9, condos at 5.2, in the range of a seller's market. Would you agree?
I'm sorry. You just said single family homes are
2.9, sorry, 2.9 for
2.9.
single
Yeah.
family homes and 5.2 for condos.
Yeah.
And looking at the condo number at
Yeah.
5.2, that would generally be in the range of what we consider to be a buyer's market.
Yeah, I mean, the numbers definitely have that flavor. I think these rules of thumb, like 4 months of inventory being in equilibrium, you have to think about a little bit because, for one thing, the title companies have just gotten way better at what they do. Technology is helping them out. So maybe, maybe three is the new four. But either way, the single family segment numerically looks much tighter than the
Yes.
condo segment. Or to put that on its head, condos got some problems, and problems that are not being experienced in the single family segment, and we see that in pricing.
Right. And we've talked about the pillars of that problem multiple times. One part is the insurance. The second
Yep.
part is the age of the buildings or the
Yeah.
vintage, the deferred maintenance
Deferred
problems.
maintenance. Yeah.
Yep. And actually the fire ordinance thing is something that's real and it's coming up and the buildings have to deal with it. And I think the good news is buyers have become more educated, realtors have become more educated, so they're asking the right questions as we go forward. Paul, let me ask you, looking at Hawaii's economy as we head into 2025, what do you see for the economy? Are we looking at a good year ahead? Are we looking at more of the same from last year?
Basically, it's full steam ahead. The numerical forecasts that I get from my colleagues at the state of Hawaii at DBED, the Department of Business, Economic Development, Tourism, and my academic colleagues from UHERO, the University of Hawaii Economic Research Organization, they're all projecting modest growth of 1.5 to 2% on trend continuing out through the 2020s, and that's a number associated with real gross domestic product or real GDP for Hawaii that matches the 1.5 or 2% growth expectation for the U.S. Now, the steady state, let's say, of full employment growth would be 1.5 to 2%, maybe 1.8%. We can see something slightly more robust than that nationwide, and have. So the U.S. economy has been outperforming most of the other advanced economies without blowing out the stops. But the U.S. has been more like a 2.5 to 3% growth economy than a 1.5 to 2% growth economy. But as I say, Hawaii's basically expected to catch up. Here's the problem: Hawaii fell. We were on the same path, Hawaii and the U.S., say the 2% growth path, and then the pandemic came, and the U.S. went down and went back to the path, and Hawaii went down and went back to minus 10%. So Hawaii's tracking with the US at the same rate without the 10% of GDP that never came back after the pandemic. 10% of GDP is bigger than the military sector in Hawaii.
It's a huge
10% of
figure.
GDP is a huge figure.
Yes.
10% of GDP is all the tourism on Oahu. So
Yeah.
something now the tourism has come back, not all the way. I'm just saying it's neither the military nor the tourism per se, although tourism is definitely impaired. It's something that happened after the pandemic, because of the pandemic, some inability to get all the way back that continues to uh, not be a drag on growth, but be a missing dollar in your wallet. And here's what I'm talking about. Per capita gross domestic product in Hawaii, which was equal to the national average, dropped net by 10% and never came back. That means $1 out of every $10 of GDP is gone without recovery. Even though the economy is growing, it's only at the same pace as the nation. So the gap, the impairment is
Yes,
persisting. And this is a real problem we need to figure out.
right.
I mean, we
And
could have
part
a
of this,
conversation about that
yeah,
another time, but that's
yeah. And I know you and I have some private thoughts on that, and we're looking for potentially some good leadership heading
yeah.
into the future. But
Leadership would be great. Get back to work would be another. I mean,
yeah,
not get back to the office, just get back to work.
yeah,
But
yeah.
or
Okay,
return to the office and get back to work. But yeah,
whatever it takes.
either have to
Uh,
work harder or sell more stuff.
okay, let's go to your five-star lock $1 million predictions for next year. So next year, January, when we do this, I'm going to ask you a question. We'll start
Okay.
with single family home prices in January of 2026,
Okay. Well,
higher, lower, about the same.
let's do this the easy way. Let's look at them after seasonal adjustment because
Okay.
I'm done making stuff up in my head, and you should be done taking my word for it. Just look at the data for a second. You've got these two interesting, mostly parallel trajectories. I'm going to say right now that condos, which you said were only up 1% year over year, which looks about right. I'm going to say that condos are not going to follow this 5% path anymore. That's kind of my new, I don't know what's going on here, but let's just call the actual path a 4% price appreciation trajectory. Then for condos, my guess would be, will they make 4%, which would be a path like this? I'm going to say for condos at or below 4%. And for single family homes, I'm going to say right at the number 4%. But here's the twist. It's 4% plus you get this bonus, this
If you
jump,
bought, yeah, if you bought before
or
the
you
jump.
owned. It's
Hmm.
this jump. This is not going away. So, consolation prize, condos, you're still on the escalator. Let's call it a 4% escalator if you're lucky. So at or below 4%. But these guys cashed in and something happened. Of course, low rates affected both segments. You can see the surge in condo prices when the interest rates were low. The other thing is the remote work phenomenon. So I'm going to have to say that remote work did do something that separated the condos from the single family homes.
Yes. And let's take a look at the Board of Realtors
Yeah.
median price statistics just so we can wrap this up. So these are the annual year-end numbers. So single family homes, we end the year at $1.1 million, up
$1 million.
4.8%. Condos we talked about earlier ended the year flat, basically up 1.3% to
Uh, let,
515.
let's call it 1 to 1.5.
Okay, we'll
As
call
I
it
said,
1 to 1.5.
consolation price.
Okay, all right. It'll be nicer to the condos.
Be nice to
All right.
condos.
If we look at 2022 in comparison, single family homes, I'm going to say it's flat, down 0.5%. And condos up 1% compared to 2022, obviously very flat. But
Yeah.
looking at these numbers, if we look at the 2023 up 4.8%, this is exactly what
Mm,
you predicted last year, that moderate growth from 3 to 5%. So well done. Now, if we go back to 2019, we
mm,
can see where we are from the prices.
yeah.
Single family homes up roughly
Yeah.
40%, condos up 21%. Um, and that's
Yeah.
what we see in the figures.
But the way I think about it is condos up 20, houses up 20, plus the 20% bonus for being a place that's more, that offers better amenities for the remote worker.
So you're feeling more bullish on the condos this year. Last year you thought probably would end the year flat, which we did. up 1.5%. You think this year we're going to see
I,
that growth trend?
I do try to be a little more optimistic, which is strange for me these days. But and here's why. All of the problems that confront condos are at least being heavily discussed, if not remediated. So we're somewhere between fixing the problem and getting serious about fixing the problem. We're
Mm.
beyond the denial stage of grief. We're moving into the okay, I got to do something about this condo. My association has got to do something about this building or whatever. Now that's a trajectory, and the wildfires in LA and the tropical cyclonic events in the southeast over the last couple of years, even in the last couple of weeks, those have obscured the or increase the uncertainty associated with insurance costs. But we all recognize that we this is the world we live in, and we're we're no longer in the denial stage, and I think most people
Okay.
recognize that we've got to do something. And so that to me that's encouraging, and
Okay.
we will either scrape those buildings and build new ones or fix the ones we have.
All right. So we'll go on that positive note. Okay, now let's get your predictions for 1 year from today. So January 2026, single
Yeah,
family homes, higher, lower, about the same.
no higher. I'm going to say 4%.
Okay. Condos, same question, higher, lower, about the same.
Yeah, I would say higher, if not quite 4%.
Okay. All right. And then what about,
Remember that the
yeah,
glide path will involve some interest rate subsidence,
yes,
provided there aren't negative fiscal policy surprises.
yes. Okay. And what about interest rates 1 year from today? 30-year fixed.
So that's part of the slow grinding, scenario. But 30-year fixed, 1 year from today, I'm going to say six the figure. It ought to
Six
have a five handle.
will not have a five.
It ought
Okay.
to, but
Yeah.
I mean, 575 would be a dream.
Okay. Okay. Sounds good. And then who do you think is going to win the Super Bowl?
Who's even playing in the Super Bowl? Do I
That's
even
what
know who's
Anders
playing in
said.
the Super Bowl?
Okay. It's all right. Don't worry about it. Well,
Sorry, I
we'll
haven't watched
edit
the Super
something
Bowl in
in.
about 10 years.
We'll edit
Um,
something in so you'll get that one correct as well.
yeah.
And
Oh,
then,
I know who will win the Super Bowl, the
okay.
halftime show.
Okay. Good answer. All right. Paul, always a pleasure. Thank you very much for taking the time.
Been
And
fun.
we'll see you next month and we'll keep this going. And then next month, we're going to do a also an in-depth dive on the neighbor island. So we'll have some good information for that as
I
well.
will be happy to serve up some good data for that.
Sounds good. All right. Well, take care. For everybody watching, be well, be kind, and until next time, aloha.